Hello, my name is Debbie Bray and I'm a tutor with LexisNexis Tolley Tax Training. Today's lecture is a review of the ATT Paper 2 pre-revision mock. Basically just having a look through the exam, pointing out the difficult areas and working through one short form question in full and one long question looking at the Boxer Limited Corporation Tax question 2. So you'll find it helpful to have in front of you the ATT Paper 2 pre-revision mock for May 2013 and also the tax tables that you would have available in the exam. So on the screen at the moment is the exam questions from this pre-revision mock. So just looking through the short form questions, ones that I really wanted to pull out. Question 1, straightforward, things to identify. Here you're dealing with an individual, so a sole trader, when you come to calculate your capital allowances. So do think about things like private usage, etc. And looking at the requirements straight away, it says you're dealing with a period ended, so you're not dealing with a year end, so think about your time apportionment, etc. Now obviously the capital allowance rules have changed with effect for individuals from the 6th of April 2012, so you're going to have to do a working to work out the maximum annual investment allowance and the writing down allowance percentages. I'm not going to do those now because we're going to see those in the written question to Boxer Limited. Question 2, straight from the legislation, things that you should make sure that you look up or can find. This is in section 217 of ITOIA 2005, looking at the rules for the change in accounting date. Now, the things that I would expect you to know going into the exam is that it's in ITOIA 2005 because it does relate to trading and a sole trader. But even if you don't know that it's in ITOIA, get used to using the index at the end of either Part 1C or at the end of Part 2 to find areas, because if you can find these, they're 3 quick, easy marks in the exam. If you can't find them, then guess, put down what you can within the time. Now, the short form I actually wanted to run through with you is question 3, because this is an area that a lot of people find difficulty with. We're dealing with an individual, a sole trader, who's ceasing to trade, and the requirement is asking you to calculate the individual's terminal loss. But notice from the requirement, not only do you have to calculate it, you also have to state how it may be relieved. So the first thing that I would write in an exam answer, bearing in mind it's worth 4 marks, I would state how it may be relieved before I do the calculation. And that's nice and straightforward. It may be relieved against trading profits or trading income of the 3 previous tax years on a last in, first out basis. Okay, so what I want to spend the time with is calculating the terminal loss for Mike. So, on a piece of paper, how would I go about calculating the terminal loss for Mike? I personally would draw a timeline, and on that timeline I would start with the end, and at the end I would put the date that trade ceased. Now, trade ceased on the 31st of December 2012, and that final period, well, how long is it? It was a year to May 2012, so then after May is going to be June, July, August, September, October, November, December. I've just counted that on my fingers, so that gives me a 7-month period as his final accounting period. And it is really important that you identify the length of that final accounting period because it will help us in our calculations. Prior to that, he had a year end of the 31st of May 2012. Now, to calculate your terminal loss, remember, it's the loss of the final 12 months of trade. So starting at the 31st of December 2012, I'm going to go back in time 12 months. And that's going to take me back to the 1st of January 2012. Now, in that final 12-month period, I need to identify where does the 6th of April fall. Somewhere here. It doesn't have to be an exact representation. So it will be the 6th of April 2012 in this case. And the reason we have to do that is because to calculate the terminal loss, we do it in 2 parts. We go from the 6th of April 2012, the start of the new tax year, to the date trade ceased, and that's going to be one calculation. And then a second calculation goes all the way back to the 1st of Jan 2012 up until the 6th of April, i.e. that's going to be a second calculation. If either of these calculations end up with a positive number, then we count it as nil in our terminal loss calculation, and that's why this split is important. So first of all, step one then, looking at the period from the looking at the period from the 6th of April 2012 all the way through to the 31st of December 2012. But the problem we've got in this calculation is that these months from the 6th of April to the 31st of May fall in this accounting period, and the rest fall in the 7 months to December 2012. So we need to split this again in two. So first of all, we're going to calculate from the 6th of April 2012 through to the 31st of May 2012. We do it to the nearest month. That's going to be April and May, i.e. it's going to be 2 months of a year end, so 2/12 of the tax-adjusted figure they've given us, and in this case they've given us a profit of £24,000. So 2/12 of a £24,000 profit is a positive number of £4,000. And I'm going to put this in a middle column, an indented column. Okay, I'm then going to calculate from the 1st of June 2012 through to the 31st of December 2012. In other words, I'm now calculating this period here. Now, in our case, that's a whole accounting period. It's the whole 7 months to December 2012, and we've been given a loss, so it's a negative figure of £18,000. Now, we haven't quite finished, because when we're calculating the step from the 6th of April to the date trade ceases, we've also got to remember to deduct any unrelieved overlap profits. And the unrelieved overlap we are given in this case. So looking at the question paper, we're told that Mike has unrelieved overlap profits of £10,000, so I'm going to deduct them, so I'm putting that as a negative number. So overall, if I add up step one, I've got an £18,000 loss, a £10,000 loss, but I've got to remember to decrease that loss by the £4,000 profit. In other words, I end up with a £24,000 loss. So because that is a loss, it's a negative number, I will take it across to my final column, which is keeping track of the actual terminal loss. So I've dealt with step one, now all I've got to do is step two. And in step two, remember, we're calculating from the 1st of January 2012 through to the 6th of April 2012. So I'll jot that down as my step two calculation. From the 1st of January 2012 through to, well, strictly speaking, it should be the 5th of April 2012, but we're always going to ignore those 5 days in April anyway. So that's going to be January, February, March. It's going to be 3 months. 3 months of this accounting period, the year to May 2012. So it's going to be 3/12 of the tax-adjusted figure for the year ended May 2012. So 3/12 of a £24,000 profit. So you could work that out. It gives you a profit figure of £6,000, but there was no need to really do that because that's the only part in step two. Overall, step two is a profit, and therefore we're going to take nil into our calculation of the terminal loss. And therefore the terminal loss for Mike is £24,000. So there's probably in this short form 3 marks going for that calculation, and remember every bit of it that you do that is correct will earn you credit. There'll also be 1 mark going for explaining how it can be used. So even if your mind goes blank on the day, do the bits you can do, guess the bits you can't, and move on. So going back to the question paper then, in terms of the other short forms, the next short form that I just wanted to point out to you was short form 6. Here you're dealing with an individual, a sole trader. They've made losses and you're asked to calculate their Class 4 national insurance liability. Just a minor point to remind you of, something that you might have completely forgotten. This individual has incurred a trading loss in their year to June 2011, and we're told that they have been trading for many years. So in other words, the tax year of this loss will be 2011-12. The loss amounts to £20,000. What we're told here is that the individual decides to use this £20,000 trading loss, and they're going to claim it against their other income for 11-12. Now, this is a red herring. That's what they're going to do with the loss for income tax purposes. But for national insurance purposes, for Class 4, you ignore any income tax loss relief claims that have been made. And so, effectively, that's a red herring. You ignore it completely. And instead, all you do is you carry that £20,000 loss forward and set it against the future trading profit from the same trade, i.e. the 2012-13 trading profit of £40,000. So for Class 4 NIC purposes, in 2012-13, your Class 4 profits are only going to be the net figure of £20,000. And then you'll use your tax tables to calculate the Class 4 NIC on that figure. Okay, moving on. Question 7, corporation tax loss relief. Again, just make sure you remember that for corporation tax, there's a set order. You have no choice. You have to, first of all, use that loss against the other income and gains in the loss-making period first. So that will use up 15 grand of your loss, which means you've only got 25 grand left to then carry back to the previous 12 months. 8, 9 and 10 are all accounting questions. Question 11 is looking at the calculation of a gain for an individual, and it involves entrepreneur's relief, so make sure that you're okay with the basics of entrepreneur's relief. VAT tax points in question 12 comes up an awful lot. Again, look at the answer if you didn't know it. Fairly straightforward set of rules that you just need to learn and practice applying. And then finally, the other short forms just to point out, questions 13 and 14. 13 is an ethics question. 14 is a law question. You might not like your law and ethics. There's enough else for you to learn in ATT paper 2, but in all likelihood you are going to get some marks in the exam, either as a short form or as part of a long question on your law and ethics. So do practice as many of these questions in the revision question bank as you can, but if all else fails, on the day, guess. Put something down, don't leave it blank. So for instance, question 13, looking at the practice guidelines and what you have to do to comply with the Data Protection Act about a person's individual information, well, a sensible guess would be to keep it confidential, and that will get you 1 out of your 4 marks. Okay, so that's all I wanted to say on the short form questions. Don't get bogged down in the short form questions. If you come across one and you really don't know, leave it, move on, come back to it at the end. In terms of the long questions, question 1 was fairly straightforward, dealing with a partnership, looking at the requirements, fairly easy spread, calculation of the adjusted trading profit for the partnership. It's for a year end, so nice and straightforward there. Even if you get that number wrong, then you'll get a follow-through marks for what you then do with it in part 2, which is your allocation between the partners of those profits. Now, what you'll normally find in questions like this, which is what you had here, is that there's going to be a different partnership sharing agreement. So up until the 30th of June 2012, there was one partnership agreement, and from the 1st of July 2012, there was a different partnership agreement. And that's midway through this year end. So what you're going to have to do is evenly split the profits, and then you're going to have to use the different partnership agreements for each part of that year ended the 31st of March 2013. Just remember, from the information you've been given, you're dealing with salaries and profit share. Well, the salaries are always given per annum. Here it does say annual salary, but even if it didn't, they always give you that information per annum, and you won't be dealing with a full year's worth, because the year ended the 31st of March 2013 falls partway between the two partnership agreements, so do remember to time apportion those figures. Then allocate them to George and Michael. When you read the information, you're dealing with closing year rules for George, opening year rules for Michael, but they're only worth 2 marks, so don't get bogged down. Another 2 marks. In Part 4, you're looking at payment due dates for income tax liabilities. Well, payment due dates are nice and easy. You should know them, get them down, 2 marks in the bag. Notice you weren't asked to calculate the income tax liability, so don't waste your time doing things like that. And then the final 6 marks of the question, 6 whole marks, are looking at the implications of the potential new partner on the partnership. So when you look at the information here, what you're dealing with is an individual who's an employee receiving employment benefits and a salary, and she's now going to become a partner. And so what you basically got to talk about here for 6 marks is the fact that once she becomes a partner, her salary will be disallowable and there won't be any tax relief for the cost of any of the benefits provided to her. And the national insurance position will go from being Class 1 primary and secondary as an employee to being Class 2 and Class 4. And as with any written part to any question, make sure that you have short paragraphs and lots of space between those paragraphs. It makes it easier to read and you're more likely to get the marks available. Now the question I want you to spend the time on is question 2, Boxer Limited. Because in my experience as a tutor, corporation tax tends to be one of those areas that people don't like so much at ATT paper 2. So let's see if we can work through this question together. First of all, start with the requirements once you've worked out your timing for a question. And the requirement is simply asking us to calculate the corporation tax liability of Boxer Limited. It says it's for a year end, so that's helpful. But it's the year ended the 30th of September 2012. So a couple of thoughts should be going through your mind at this time. You're going to be dealing with a financial year straddle potentially when you come to calculate that corporation tax liability later on. And when we come to do the capital allowances working, we're going to have to do a careful calculation to work out the AIA maximum. And we're going to have to do a working to calculate the writing down allowance percentages, because it's going to straddle for a company the 1st of April 2012. So, first thing I would do, I would set up on a piece of paper a CT Comp Pro Forma. We're dealing with Boxer Limited, and we're dealing with the year ended the 30th of September 2012. So I'll jot that down. The year ended the 30th of September 2012. Now, keep that piece of paper for your CT comp. We know that we're going to have trading income at some point. We don't know what else is going to go in there, but we can take numbers straight to this CT comp page as we come across them. Now, other things we know that we're definitely going to need. We're going to need to do a calculation of our adjustments to profits, because when we look at the information in the question, we can see that we've been given a P&L. So I'll have a whole page dealing with my adjustments to profits calculation. And I'm going to have a page dealing with my capital allowances working. And if you wanted to, there's absolutely no reason why you couldn't start straight away with your capital allowances working, because we need to calculate the AIA maximum. No doubt that will be tested, so that's something I would always straight away think about. Now, if we're dealing with, remember, the year end, the 30th of September 2012, that will have started on the 1st of October 2011. So from the 1st of October 2011 through to the 31st of March 2012, so that's going to be October, November, December, Jan, Feb, March, so it's going to be 6 months. For that 6-month period, the AIA maximum was £100,000. But we're only going to be entitled to 6/12 of it, i.e. we're only going to be entitled to £50,000 covering that period. In addition to that, we're going to be looking at the time period from the 1st of April 2012 through to the 30th of September 2012. So that's going to be April, May, June, July, August, September. So that's going to be another 6 months. And for that period, the AIA maximum is £25,000 per annum. So we care about 6/12 of £25,000, which gives us £12,500. And hence, the AIA maximum for this year end will be £62,500. That's the maximum we can put in the AIA column. But a word of warning, within that maximum, only £12,500, i.e. this prorated figure here, that will be the maximum for the expenditure incurred from the 1st of April 2012. So when we come to deal with our additions in our capital allowances working, the best thing to do is deal with additions, first of all, that were bought prior to the 1st of April 2012, and then those that were bought after that date. Next, why don't we calculate the writing down allowance for the main pool, the general pool, because we're going to definitely need that. So we know that for the first 6 months, from the 1st of October 2011 to the 31st of March 2012, the writing down allowance we're going to care about, and if you need to, look on your tax tables on page 4, was 20%. So that's going to be 20% times 6/12, i.e. that's going to be 10%, plus from the 1st of April 2012 to the 30th of September 2012, we're now looking at a writing down allowance percentage of 18%. That's per annum. We only care about 6 months worth, so we're going to take 6/12 of that figure, i.e. that gives us 9%. And we add those two together, and that gives us a writing down allowance of 19% for this year end. We can then set up the basics of our capital allowances working. I'm going to have some space for some narrative. We're going to have a column to deal with the AIA. We're going to have a column to deal with the main pool or the general pool. Both terms mean exactly the same thing. We don't yet know what other columns we're going to need, but on the far right-hand side of the page, I'm going to keep track of my capital allowances and have a capital allowances column. Okay, so I've done all that, and I've not yet started reading through the question. But I've calmed myself down and I've got the workings ready. So, going back to the question paper. Okay, so looking at the question paper then. First of all, we're given the profit and loss pro forma. So we start with the profit before tax figure of £1,036,300 and take that to our adjustments to profit working. You always start with the profit before tax. Sometimes in an exam question, they'll call it the net profit. Then, looking through that question paper, don't forget to look at the summary P&L. Don't just start looking at the notes. So, for instance, we've got interest receivable of £17,800. Well, that, for a company, isn't taxed as part of your trading income. It's taxed as your non-trading profits from loan relationships. So there will be two things that I'm going to do with that figure. First of all, I'm going to deduct that interest receivable in my adjustments to profit working. So I'm going to deduct 17,300 here. But at the same time, I'm going to go to my CT comp pro forma that I've already set up, and I'm going to have a line there saying non-trading profit from loan relationships. And on the face of the CT comp, in brackets, I'm going to put £17,300. And the reason for that is I don't yet know if I'm going to have any non-trading deficits from loan relationships. In other words, any interest expense on non-trading loans that I've got to deduct from that. So I'm going to tick that off. I've dealt with it. Next, dividend income, £22,500. So this is dividend income. It shouldn't be part of the trading income of the company. I need to deduct it. And it does refer me to note number 1. And in note number 1, it tells me that these dividends were received on the 10th of August 2012 from Glove Limited, a company in which Boxer only owns 5% of the shares. And the reason that's relevant is because Glove Limited is not an associate of Boxer. Therefore, this dividend income is going to be franked investment income for Boxer. So the two things I'm now going to do with this dividend income. First of all, I'm going to deduct it in my adjustments to profits working. So I'm deducting £22,500 here, but I'm also going to go to the very bottom of my CT comp pro forma, and at the very bottom of the page, I'm going to show my calculation of FII, franked investment income. And remember, that is the dividends received of £22,500, grossed up at 100 over 90. So that gives me a figure of £25,000. Now, that's not going to be part of my TTP, my taxable total profits, but it is going to help me calculate my augmented profits. Okay, back to the question paper. And the next thing that we're looking at is the expenses. We're looking down this list of expenses here. Staff costs, legal and professional fees, so far, no issues. Property costs, sounds okay. Depreciation expense, however, I know I have to add back. So I'm going to add that back straight away, £92,300. And in my adjustments to profits working, I'm going to add back depreciation. You don't have to write it out in full. As long as the examiner can see what that figure relates to, as long as there's some narrative there, that's absolutely fine. So I've dealt with that. I'll tick it off. I'll then start reading through the notes because I don't know anything yet about motor expenses, so they could be okay as well. I've dealt with the dividend income note. Next, the staff costs note. Staff costs include accrued occupational pension scheme contributions of £18,000. Well, you're not allowed to get tax relief for any accrued pension contributions, so I'm going to have to add those back. And we're also told they include bonuses of £35,000, which are expected to be paid to the directors in April 2013. Well, remember, we're looking at a year end of the 30th of September 2012. Provided those bonuses that are included in those accounts are paid within 9 months after the 30th of September, then they're okay. So October, November, December, January, February, March, April, well, they're going to be paid within 7 months of the year end, so they are okay, and hence no adjustment is going to be required for those. So all we've got to do here is in my adjustments to profits working, we're going to add back the accrued pension contributions of £18,000. And I'll tick those off. I've dealt with them. Looking at legal and professional fees. Accountancy fees are fine. Debt recovery costs are fine because that's part of trading. You're going to have to chase debts. However, if a legal fee relates to either something that is capital in nature or if it relates to something that is disallowable for tax purposes, such as penalties and fines, then the legal fee is also disallowable. So here, the legal fee is to do with the fine for breach of health and safety regulations of £10,350. We are going to have to add back. The legal fees re staff recruitment, again, they're fine. That's part of the normal trading expense. So all we've got to do for note number 3 is add back £10,350 re the legal fees for the fine. And then I'll tick those off on my question paper. I've dealt with them. Looking at property costs, electricity fees, absolutely fine. The movable partitions. Movable partitions are eligible for capital allowances. They're deemed to be capital expenditure, so whatever happens, we'll have to add them back in our adjustments to profits working, but we can get capital allowances for them because they are included in the Capital Allowances Act in that list in section 23 of items that are plant and machinery. So the reason it's given us the date is because in our capital allowances working, we need to distinguish between items that were required before and after April 2012. So two things we're going to do with this. First of all, we're going to add back the cost of those movable partitions in our adjustments to profits working. Because it's capital expenditure, it's disallowable. So I'm adding back that £16,800. But before I do anything else, I'm going to go to my capital allowances working, I'm going to put in additions pre the 1st of April 2012, and I'm going to put movable partitions. The cost of those movable partitions is £16,800, and so I'm going to put them in the AIA column. So going back to the question paper, I've dealt with them everywhere I need to. Move on. Sundry repairs and renewals, I'm not told anything about them, so I have to assume they're okay. Next, looking at the motor expenses. We're told motor expenses include £9,000 of operating lease payments on a BMW car for the managing director. The lease was entered into on the 1st of April 2012. We're given the list price of the car, that's irrelevant, but what we are told is that the CO2 emissions of this car are 172 grams per kilometre. That's more than 160 grams per kilometre, and that means that we're not going to be allowed tax relief on the whole £9,000 of operating lease payments. Instead, we're going to have to add back 15% because that's the rule. Now watch out, we're dealing with a company. So the fact that the managing director uses the BMW for business and private purposes is completely irrelevant. It's a red herring. So all I'm going to do with respect to this information is in my adjustments to profits working, I'm going to go back and add, with respect to the operating lease, 15%, the disallowable proportion of the £9,000, and show a little working, because if you were to get the number wrong in your calculator, as long as your working is there, you'll get full marks. Okay, so looking back at the question, the only other information we've been given is to do with capital allowances. So we've been given the tax written down values brought forward. Here they're calling the general pool the general pool. Again, main pool, general pool means the same thing. So let's pop that information into our capital allowances working. So the tax written down values brought forward in the main pool are £89,600. Tick that off, we've dealt with it. We've also got a short life asset column, the computer, and the figure we're given brought forward there is £45,800, and we have also been given the special rate pool. So in a minute we're going to have to go and calculate the writing down allowance for this year end for the special rate pool. No point doing it until you know you're going to need it. We're then told, looking back at the question paper, that there were a couple of other additions. A new delivery van was purchased in March 2012 for £20,000, so I'll take that to my working. It was an addition before the 1st of April 2012, so I'll put it here, the van, 20,000. And we're also told that the old computer system, the short life asset, was part exchanged for a new system with a cash price of £62,000. A part exchange allowance of £36,000 was received. Well, remember, with part exchange, two things are happening. You've got a sale of the old, and you've got the purchase of the new. So two completely separate things happening for capital allowance purposes. For the sale of the old, the sale proceeds received is the part exchange allowance of £36,000. So put that into our capital allowances working. A bit further down, I'll deal with my disposals. And for my disposal, remember we always deduct the lower of cost and sale proceeds received. Here, sale proceeds received clearly will be the lower figure because £36,000 is lower than the tax written down value brought forward in that computer short life asset column. We've also got to deal with the cash price purchase of the new computer system of £62,000, but this happened in August 2012. So this is where we've got to be careful, because remember, we've already worked out our maximum AIA. The maximum for expenditure that had been incurred prior to the 1st of April 2012 could have been that whole £62,500. However, what we're now looking at is expenditure that was incurred on or after the 1st of April 2012. And for this expenditure, we can only put a maximum of £12,500 worth into the AIA column. So when we're looking at the addition that was incurred after the 1st of April 2012, the addition of the computer, we are only allowed to put £12,500 of it in the AIA column. We will get capital allowances on the whole 62,000, but the remaining amount, so just plugging that into my calculator, the remaining £49,500 we'll just have to take to the general pool or the main pool. Now, if you want to, you could set up a new short life asset column for it, but it won't make any difference to your numbers. It's only a difference in the period of sale. So, I've dealt with my additions, I've got my disposal. What I now need to do is balance off all the columns and work out the capital allowances. So, in my AIA column, I've got 16,800 plus 20,000 plus 12,500. That gives me £49,500. So let's jot that down. That's 49,500. Straight away, in my narrative, I'm going to show AIA at 100% for the whole 49,500. So that's now empty. But I've got to remember to take that 49,500 across into my capital allowances column. Next, adding up my general pool, my main pool, the tax written down value brought forward of 89,600. To that, I'm going to add the 49,500 read the new computer system, and that gives me a figure of £139,100. Here, I'm calculating a writing down allowance at, well, let's remind ourselves, what was the rate? It was 19%. So a writing down allowance at 19% applies to this figure, giving a writing down allowance of £26,429 that I'll take across into my capital allowances working. Now the next column I've got is the computer short life asset. Because it's been sold, I'm just going to work out a balancing adjustment. So all I'm going to do in this column is start with the tax written down value brought forward figure of 45,800, and I'll deduct from that the £36,000 of disposal proceeds. Now that gives me a positive number of 9,800. And what that means is that's a bit of cost that has not yet had tax relief. I should get tax relief for it, therefore I'm going to have a balancing allowance. Now, to be honest, from an exam point of view, it's perfectly acceptable just to do a double underline underneath that, and if that's a positive number, then you take it as a positive number to your capital allowances working. Alternatively, you can show that column being brought down to nil and take away the £9,800 from that column, but what you've got to remember is if you were instead to do it this way, in other words, if you were to deduct the 9,800 to bring that column down to nil, what you've then got to remember is, that is a balancing allowance, and therefore I've got to show that as an allowance, as a positive number in my capital allowances column. Do whichever you prefer. Okay, and then finally, all we've got in the special rate pool is the £230,000 of tax written down value brought forward. Nothing else has affected that pool in the period. So I'm going to do a quick working to my special rate pool, WDA. That was 10% before April 2012, so I'm going to calculate 10% times 6/12, giving me a figure of 5%, and then after April 2012, it became 8%. And again, I've got 6 months worth from April 2012 to September, so I'm going to be looking at adding 4% to that, giving me overall 9% as the writing down allowance in the special rate pool. So my writing down allowance that I'm going to use on that £230,000 is 9%, and that gives me a figure of £20,700, which I take across. Now, in the exam, I wouldn't waste your time balancing off each column. The only column you now care about in this question for capital allowances is that capital allowances column. So I'm going to add up all of these numbers to give me my total capital allowances. So 20,700 working backwards plus 9,800 plus 26,429 plus 49,500, and that gives Boxer Limited capital allowances of £106,429. These capital allowances I now take to my calculation of trading income. I'm going to put them right at the bottom of my adjustments to profits working, and I'll deduct those capital allowances of £106,429. And now, if I add up this working, it will give me the trading income figure. So to save us a bit of time, if we were adding all of this up, we would end up with a figure of £1,029,071. And that is the trading income figure. And the beauty when you're dealing with a company is that that's it. There's no allocation to tax years. That's the figure that we're just going to take straight into our CT comp as trading income. Please, if you're deducting your capital allowances, don't deduct them on the face of the CT comp, because what some people tend to do is deduct capital allowances down here and have their tax-adjusted trading profits before capital allowances up here, and technically that's wrong, so you will be losing marks. If you always deduct them and you're working as we just did, then you'll always get your full marks there. Okay, so we've dealt with all the information in the question. All we need to do now is finish off the CT comp. So looking at my non-trading profits from loan relationships, that's it. There was nothing to deduct in this question. So 17,300 is the final answer. I haven't got any other income. I haven't got any chargeable gains for my company. So therefore, my taxable total profits are just going to be those two numbers added together, giving a figure of £1,046,371. And remember, it's this figure that I'm going to tax. But to work out the rate at which I tax it, I need to add to that figure the franked investment income that I've worked out earlier of £25,000, and that gives me £1,071,371 as my augmented profits. Now, Boxer Limited, we're not told about any associated companies or anything like that, so what we're going to do is just compare this figure of £1,071,000 to our normal upper limit of 1.5 million and our normal lower limit of 300,000. So in other words, we are a marginal company. Okay, now when we come to calculate the tax, we've got to be careful. We identified at the outset that we're dealing with a financial year straddle. You don't have to do a timeline, but I'm going to do one to show you what's going on here. We're dealing with the year end of the 30th of September 2012. And because it's a year end, that started, as we know, on the 1st of October 2011. What I do, because it's easy to make a silly mistake on things like this, I draw the timeline and then I simply show on that timeline where the 1st of April falls. So in this case, the 1st of April falls here, and it's going to be the 1st of April 2012. So from that date onwards falls into financial year 2012, and anything prior to that date falls into the previous financial year 2011. So, how many months fall in financial year 2012? Well, April, May, June, July, August, September. In this case, 6/12. And therefore, I'm going to tax 6/12 of the TTP at financial year 2012 rates. October, November, December, January, February, March means 6 months, and hence 6/12 of the TTP fall in financial year 2011 and will be taxed at those rates. So get your tax tables in front of you. Don't try and memorise them because it's easy to make a silly mistake. So on page 4 then, doesn't matter what you start with, I'm going to start with financial year 2012. And looking at financial year 2012, I'm going to take the TTP of £1,046,371. I'm going to multiply it by 6/12 because only 6 months worth fall in financial year 2012, and I'm going to tax that at financial year 2012 rate, which according to my tax tables for a full rate company, for a large company, is 24%. And when I plug that into my calculator, that gives me a figure of £125,565. I'm then going to deduct marginal relief for financial year 2012. So the fraction that's relevant for 2012, according to the tax tables, is 1/100th. And what I do, I use the full 12-month figures. So I'm going to use the full 1.5 million upper limit. I'm going to deduct the full augmented profits of £1,071,371. I'm then going to multiply by the fraction with TTP being 1046371 on top, and on the bottom being 1071371 for the augmented profits. But what I've got to remember to do at the end is multiply all of that by 6/12, because only 6 months worth falls into financial year 2012. And when I plug all of that into my calculator, I get a figure of £2,093 for marginal relief, and remember that's a deduction. And then I'm going to do everything again, but this time using the financial year 2011 rates. So my TTP again was £1,046,371. Only 6 months worth fell into financial year 2011, and according to my tax tables, the rate that applied to a full rate company was 26%. And that gives me a figure of £136,028 for tax purposes. I'll then deduct my marginal relief using the fraction that's applicable for financial year 2011, and on my tax tables, that fraction is 3/200ths. Don't try and memorise it. But the rest of this calculation is exactly the same as before. So it's going to be 1.5 million less my augmented profits of £1,071,371 multiplied by my fraction with TTP on the top for the full year and augmented profits on the bottom for the full year. And again, remember to multiply all of that by 6/12. And when I plug all of that in, it gives me a figure of £3,140. I've finished. All I've got to do now is to add all of these numbers up to give me my CT liability for Boxer Limited for the year. And in this case, the CT liability works out to be £256,360. Okay, so that is your CT comp question. To finish, just a couple of minutes I wanted to spend looking at the accounting question, more of an approach than anything else. Accounting is another area that students often feel a bit unhappy with. Here we've been given a requirement to calculate a profit and loss account for a year to June 2012 and a balance sheet as at the 30th of June 2012. And from the requirements, we've not been told we've got to perform double entries in debit credit format or in T accounts or anything like that. Any sensible workings to get to the end result will get us our marks. And in this question, when we look at the information, we're dealing with wrong K, in other words, an individual, a sole trader. We know we're dealing with a year end, we've already been told that, and we've been given the TB. After the TB, we've got some information of items that either need to be adjusted for in the trial balance or just haven't yet been calculated. Now, the way I would start a question like this, I would actually have a whole page in my answer setting up my basic P&L pro forma. And I would put sales less cost of sales, and I'd break that down, showing opening stock plus purchases less closing stock, leave some space, and then put less expenses. Then on another page, I would set up my basic balance sheet pro forma. You know you're going to have fixed assets, leave space, you don't know how many. You're going to have current assets, always going to need stock, debtors, and cash. Leave some space between them because you might be dealing with prepayments, etc. You're going to have creditors due within 1 year. Then leave some space to give you your net assets figure. And then at the bottom, because we're dealing with a sole trader, we're going to have capital plus profit for the year, less drawings. Now that's already setting it up in the bag. What I would then personally do, before putting in this information, I would work through the post-trial balance information, because these are going to potentially change some of the figures that you have been given in the trial balance. So, for instance, the first question here, you're talking about a prepaid amount, because we're told that the rent for the month of July of £480 was paid on the 29th of June and is included in the rent expense above. Well, the rent expense, if we look at the TB, shows a figure of 6240. In other words, that's too high by £480. If you were dealing with the debit and credit format, which you don't have to do, then what you would be doing is decreasing your expenses. So you would be crediting your rent expense with that £480, and you would be debiting prepayments, increasing your prepayments asset in the balance sheet by that £480. Now, the only reason I've done that double entry is to explain to you what the answer then does. Because if you look at the answer to this question, so if I just scroll through the answers document until we get to the answer to question 3. What you might find helpful, you could set up at this point, under your list of expenses in the P&L, a heading for rent. And you could now show a negative figure of 480. Because you're decreasing rent expense. You could start by doing that, or you could take the figure from the TB, which showed rent expense of 6240, and put that in brackets first, and then deduct the 480. But that's what they're doing to show the credit to rent expense, the decrease to rent expense. And in the balance sheet, set up a prepayments heading, and you've left space, there's space for you to put it in, and your debit to prepayments is this positive number, an increase of £480 here. And effectively, using brackets next to your narratives on the face of the P&L and the balance sheet pro forma is how I would suggest you show your double entries. So just going back to the information that you've been given, you've also got to do a depreciation double entry. It's straight line, so it's on costs, so you don't have to look at calculating the net book value. You've got your standard closing stock double entry, but again, the beauty of this is, because no double entry is required, all you've got to do is know what to do with closing stock in your pro formas. And in your pro formas, the figure that's on the balance sheet for stock, this is your closing stock. And in your P&L, you know that closing stock decreases your cost of sales expense. So you don't even need to worry about that closing stock double entry. You've then got to deal with wages expense for an employee. So that's just going to increase your wages expense, and it's outstanding at the year end, so it's an accrual. This figure here for Ronke represents drawings. So at the moment, wages expense includes £18,000 for Ronke as drawings, and it needs to be taken out of the wages expense. So we're going to decrease our wages expense by £18,000, and we're going to increase our drawings by £18,000. And again, in the answer, that's what they're doing. In wages expense, they're decreasing it by that £18,000, and if you go to the bottom of the balance sheet, the drawings figure that we deduct on the bottom of the balance sheet is that £18,000. The government grant, well, there are two types of government grant, capital or revenue. This government grant is to help towards the cost of employing her employee for the first year, so this is going to be a revenue grant. In other words, you can take it straight to the P&L when you receive the cash. Now, they don't receive the cash until after the year end here. So, effectively, what you've got to do, looking at the answer, you've got to include that income in your P&L, because you have earned the money during the year end, and so just below the gross profit line you show the grant income, but because you haven't yet received the cash and your business is owed that money, you've got a type of debtor, they're calling it accrued income, but if you get confused by that terminology, then just call it a grant debtor, and that is perfectly acceptable, and that's what that £1,800 figure is there. Okay, and then the final adjustment here that we can see before I scroll down, accountancy fees. You've got to add VAT to them. They haven't been paid at the year end, so that's an accrual. So that's going to increase your accountancy fee expense, and you're going to have an accrual in the balance sheet. You've then got a couple of other adjustments. Advertising expenses. You've paid it all on the 1st of June in the year end, but some of it relates to after the year end. So 2/3 for the months of July and August, 2/3 of that payment of £240 are prepaid. So you'll decrease your advertising expenses by that amount and you'll increase your prepayments. And then finally, you've got to write off a debt because adjustment number 8 is telling us about someone who's gone bankrupt. And so writing off the debt, we're decreasing our debtor asset by that amount of 120, and we're going to have a bad debt expense in the P&L of 120. Now, at the end of the day, if you get bogged down with any of those adjustments, guess and move on, because you could pass this question virtually by setting up your pro formas and putting most of the information that has been given to us in the TB in. You probably need to get 1 or 2 adjustments to ensure yourself of a pass, but you'll get an awful lot of really good marks even if you didn't deal with the adjustments. You just took all the info in the TB straight to the relevant places in the P&L and the balance sheet. So please, whatever you do, don't give up on accounting. Do the bits you can do, guess the bits that you can't, but make sure you take the TB information into the P&L and balance sheet before the end of your time. And then finally, you're always going to get some kind of written question in the exam, and the one you had here was a letter. Make sure you're using your proper letter format. Set that up at the start. Make sure in your letter question that you're going to have headings that relate to each requirement. So I would have a heading for badges of trade. I've had a heading for tax relief for equipment. I've had a heading for VAT registration. And then underneath, write short, sensible paragraphs that relate to each of those headings, leaving space between each paragraph. That's the end of this tutorial. I do hope you find it helpful, but don't forget, if you have any further queries or questions, then for pre-revision mock questions, you can put those on the Academy. Thanks very much. Best of luck.